Hello everyone, I'm Yazan Ibrahim, or as some of you might know me, Yazan Abu Ghosh. Today we're going to dive into a fascinating and essential topic, Fraud Examiners Section 1, Financial Transactions and Fraud Schemes. Welcome to today's deep dive into 1.4, Asset Misappropriation, Fraudulent Disbursements, 1. Register disbursement schemes, 2. Check tampering schemes, 3. Electronic payment, tampering 4. Billing schemes, 5. Payroll fraud schemes, 6. Expense reimbursement schemes. Whether you're an aspiring fraud investigator, a business owner, or simply curious about how organizations manage their finances, or if you are auditor, this journey will shed light on the often complex systems that drive decision-making. Part A. Have you ever thought about the intriguing, sometimes sneaky ways fraud can take place within organizations? Let's dive into a story of deception, trust, and the measures companies can take to prevent monetary losses. At the heart of today's discussion lies a dark yet fascinating topic: fraudulent disbursement and check tampering schemes. We'll demystify how these frauds are carried out, explain their mechanisms, and most importantly, outline how to detect and prevent them. Have you ever thought about the intriguing, sometimes sneaky ways fraud can take place within organizations? Let's dive into a story of deception, trust, and the measures companies can take to prevent monetary losses. At the heart of today's discussion lies a dark yet fascinating topic: fraudulent disbursement and check tampering schemes. We'll demystify how these frauds are carried out, explain their mechanisms, and most importantly, outline how to detect and prevent them. Breaking down fraudulent disbursements. Imagine this: an employee, seemingly normal and trustworthy, manipulates company funds, issuing payments that appear legitimate but serve dishonest purposes. This type of fraud is what experts call fraudulent disbursement. Unlike outright theft, these schemes are particularly deceptive because on the surface, they mimic genuine transactions. For instance, a cleverly manipulated invoice could cause the company to unknowingly make a payment for non-existent goods or services. Another employee might forge a company check or even alter time cards, simple actions that lead to significant losses. But here lies the essence of fraudulent disbursement schemes: their stealth. They blend in seamlessly with everyday transactions. Someone catching on would need to spot unusual patterns. A recurring payment to an unrecognized vendor or a discrepancy in inventory numbers might raise eyebrows. It's a bit like finding a needle in a haystack, unless clear anti-fraud controls are in place. Register disbursement, the devil in the cash drawer. Step into the world of retail registers where the hum of daily transactions hides another undercurrent of fraud: register disbursement schemes. Unlike cash larceny or skimming, these malpractices leave their fingerprints in the register logs. Essentially, they involve the fraudulent removal of cash from the register, recorded as legitimate disbursements. Two common iterations here: false refunds and false voids. Picture this: an employee processes a fake refund for an item that was never returned and pockets the cash. They carefully log the transaction, ensuring the register balances at the end of the day. The refund even reflects back in the inventory, making it appear that the non-existent merchandise is back on stock. The result: inflated inventory on paper and a financial shrinkage for the business. But false refunds aren't the only tactic. Some fraudsters ramp up their game with overstated refunds. Imagine a customer legitimately returning a $100 item. The fraudster logs the refund for $200, gives the customer their due $100, and walks away with the rest. This simple trick works because registers fail to flag refunds slightly above or below thresholds requiring closer scrutiny. And consider credit card refund schemes. Employees use their own or associated credit card accounts to push fake refunds, benefiting without ever touching a dollar in cash. These tricks often fly under the radar till anti-fraud software systems or whistleblowers come into action. The dark art of check tampering. Now let's delve into one of the most intriguing forms of occupational fraud: check tampering. Distinct from other fraudulent schemes, it directly involves manipulating checks either through forgery, alteration, or misappropriation. Imagine holding a blank check. For a fraudster, it's a canvas for deception. The tactics vary. Forged maker schemes involve an employee signing the name of an authorized check issuer, often made easier by sloppy controls. Alternatively, a criminal might alter payee details to redirect funds to accomplices or even themselves. But here's where it gets cinematic. Some fraudsters get even more creative, stealing return checks, altering their addresses, or producing counterfeit checks with insider help from printing companies. It's almost like espionage within the financial world. Concealing these crimes forces perpetrators into elaborate tactics. They may deliberately forge authorization slips, destroy logs, or tailor amounts under review thresholds. It's fascinating but sobering. It underscores the critical importance of meticulous financial monitoring and strict segregation of duties. The detectives spotting the red flags. But how are such schemes uncovered? Fraud often leaves subtle trails, much like the threads of an unraveling sweater. Managers or auditors attuned to patterns might notice suspiciously high volumes of refunds from an individual employee or an unexplained gap in inventory records. Sometimes customers themselves spot inconsistencies, like being denied a refund they never received or discovering mismatched payment credits. Anti-fraud tools have evolved too. Ensuring physical inventory tallies match perpetual records is crucial. Reviewing refund to sales ratios, verifying all documentation, and keeping tight control over register access can stymie potential fraudsters before they take root. Organizations must also encourage consumer involvement. Signs encouraging customers to ask for receipts serve a dual purpose. They ensure employees are transparent in their processes and recruit civilians into the battle against fraud. Building an arsenal of prevention. So, what can organizations do to minimize risk? Start with the basics. Review internal controls, secure access codes, and enforce review processes. For cash handling, always separate duties between reconciliation and disbursement tasks. Discourage employees from voiding or refunding their own transactions. And most crucially, keep an eye on high value or repetitive small refunds. Fraud's greatest enabler is complacency. Our focus today has been on understanding these fraudulent schemes not just academically, but as high-stakes puzzles with real-world consequences. By the end of this session, we hope you walk away empowered to recognize the signs, implement robust defenses, and safeguard your organization against these covert threats. After all, as they say, a chain's only as strong as its weakest link. And in the world of business fraud, strengthening every link starts with knowledge. Now let's talk about billing schemes. Imagine a web of deceit woven through an organization's financial system where fraudulent invoices or suspicious vendors slip through the cracks. These schemes rely on loopholes in procedures, exploiting weak controls. For example, consider a poorly managed vendor list. A fraudster might add a vendor with an unusual mailing address, a post office box perhaps. Payments flow to this fabricated entity, and without proper reviews, discrepancies may go unnoticed. To combat such practices, organizations need a fortress of preventative measures. Think of this as building a robust wall against fraudsters. It starts with carefully documented and enforced authorization procedures for purchases, invoicing, and payments. Vendor lists should be reviewed periodically, ensuring no suspicious or unfamiliar names or addresses creep in. Odd payment descriptions, duplicate invoices, or abnormal purchase levels, whether monthly or yearly, are all red flags. But there's more. Picture investigative auditors combing through inventory levels, scrutinizing journal entries related to inventory accounts, and tracking bank reconciliations for signs of tampering or out-of-place vendors. Such efforts, paired with detailed cross-checks of credit card statements to spot irregularities, act like a microscope to uncover tiny, hidden cracks in the system. With billing schemes under our belt, let's shift gears to payroll fraud, an equally insidious threat. Payroll schemes are rooted in false documentation, aiming to siphon funds from a company through manipulated payroll records. Unlike billing fraud, which often targets external disbursements, payroll fraud hits closer to home, diverting payments meant for employees into the wrong hands. So what does this look like in practice? Let's spotlight the infamous ghost employee scheme. A ghost employee is, as the name suggests, a phantom, a person who doesn't work for the company but still appears on its payroll. They might be entirely fictional, or they could be a real individual, like the perpetrator's friend or relative. For this scheme to fly, 4 steps must take place. First, the ghost must be added to the payroll. Second, their timekeeping or salary information needs to be supplied. Third, a paycheck has to be issued. And finally, that paycheck must reach the fraudster or their accomplice. The methods for perpetrating ghost employee schemes may vary. It could involve a manager abusing their hiring authority, as in the case of one fraudster who added over 80 ghost employees to the payroll. These employees were real people with other jobs, willing to split the stolen paychecks with the manager in exchange for their cooperation. Alternatively, payroll employees themselves might manipulate records, especially if they have unrestricted access to adding or removing names. This is why separating duties, ensuring no single person has full control over multiple payroll functions, is so critical. But the scheme doesn't end with names on a list. To make these ghosts work, someone needs to create or falsify documentation proving their hours or wages. In systems where employees log their hours, a fraudster might forge a time card, punch time clocks for the ghost, or input data directly into computerized tracking systems. And if a supervisor is the perpetrator, they might skip the forgery altogether, simply approving fraudulent hours themselves. However, salaried ghosts, those paid a regular amount without the need for timekeeping, can be even simpler for fraudsters to integrate, albeit more conspicuous since most salaried workers are in management positions. What happens when the paycheck is ready? The distribution phase is the final hurdle for the fraudster. If checks are mailed, the fraudster ensures that they're sent to a post office box or an address they control. Direct deposit fraud might involve the use of the perpetrator's own bank account or one belonging to their accomplice. A telltale sign. If multiple employees share the same address or account, alarms should go off. But the fraudster is often one step ahead, using subtle variations, perhaps mailing checks to an unused PO box or an account under a different name to avoid detection. Beyond ghost employees, fraudulent manipulation of existing payroll records also poses a threat. This strategy often involves inflating wages by falsifying hours worked or tweaking hourly rates. For instance, an employee might exaggerate their hours, or worse, gain unauthorized access to payroll systems to boost their wage rate. These schemes rely on lax oversight and insufficient checks for payroll accuracy, highlighting the need for robust organizational policies that prevent unauthorized access and enforce rigorous reviews. In conclusion, both billing and payroll schemes thrive on vulnerabilities in internal controls and organizational vigilance. To stop fraud in its tracks, businesses must prioritize a comprehensive approach. Periodic audits, segregation of duties, rigorous authorization procedures, and regular training for employees on signs of fraud. By maintaining a culture of transparency and constructing systems designed to flag unusual activity, organizations can transform themselves into fortresses impervious to these schemes. Thank you for watching, and as always, continue learning, stay curious, and we'll see you next video.